All right, let's talk about the absolute carnage in the silver market. If you've been watching the charts lately, you saw the white metal pull a complete 180. Just days ago, we were eyeing 84 bucks an ounce. People were screaming to the moon. And then the rug got pulled. Silver dropped over 10% in a single session, its worst haircut since 2020. Was it a glitch, a bear trap, or is the bubble finally popping? Today, we're breaking down the top 5 reasons behind the silver crash. First up, we have to talk about the blow-off top. Look, silver was up over 180% year-to-date. That's not a rally, that's a moonshot. When an asset goes parabolic like that, it almost always ends in a flash crash. Professional traders and big institutions saw the RSI, the Relative Strength Index, screaming overbought for weeks. The second silver touched those record highs near $84, the sell button started clicking. It's classic profit-taking. When the smart money exits the building, the latecomers usually get stuck holding the bag. Reason number 2 is a bit more technical, but it's the real hammer. The CME group, the guys who run the exchange, just hiked margin requirements. Basically, they made it more expensive for traders to hold leveraged positions. For the March 2026 contract, the initial margin jumped from $20,000 to $25,000. When that happens, traders who don't have the extra cash are forced to liquidate their positions immediately. This creates a domino effect of selling that can tank the price in minutes. Silver is a safe haven asset, right? Well, that fear premium just took a hit. Over the weekend, we started seeing headlines about potential peace progress between the US and Ukraine. President Trump mentioned being very close to a deal. The market hates uncertainty, but it loves peace. As geopolitical tensions cooled, the panic buy demand evaporated. Investors shifted out of safety metals and back into riskier assets, leaving silver out in the cold. Don't forget the calendar. We are at the end of the year. Investors are doing what we call tax loss harvesting, or just cleaning up their books for 2026. Combine that with thin liquidity, meaning there aren't many buyers on the floor during the holiday season, and you get massive price swings. In a thin market, even a medium-sized sell order can move the needle way more than it should. It's a recipe for volatility. Finally, let's talk about the China pivot. China just slapped new export restrictions on silver. While you'd think less supply means higher prices, the market actually reacted to the fear of industrial demand destruction. If trade wars ramp up and tariffs hit the fan, the demand for silver and solar panels and EVs could take a hit. Silver isn't just a shiny coin, it's an industrial workhorse. If the global factory slows down, silver prices follow suit. So is silver dead? Probably not. Most analysts still see a structural deficit in the long run, but this reset was a reality check for the bulls. What do you think? Is this the dip to buy, or are we headed back to the $30 range? Drop a comment below, hit that like button if this helped you make sense of the chaos, and I'll see you on the next one. Stay liquid, friends.